Hello everyone, let us continue with our discussion and hopefully this is going to be our last session where we are going to discuss about the volatility forecasting. Now you see that this portion of volatility forecasting, though if you look at from the author's perspective it's very numerical, but from the exam perspective it is going to be touched upon based upon a theory only. Okay, now over here what we will study about the variance covariance, clear, which we have discussed a lot in our level 1 and level 2. So I'm not going to teach you how to calculate this variance or covariance matrices. No, the important aspects I'm going to cover up because they are going to teach you multi-factor models. They are going to teach you the arch over here, which we have studied in the time series and regression. So I cannot pick up the whole regression and time series over here. So what's important, what's relevant for our discussion, that I am going to discuss. Like I'll give you just one example, like war. I cannot teach you war over here because you know that we have studied a lot about it in our previous session. So what's important over here that we are going to cover up in these sessions. Okay. Now, if you'll ask me, sir, what is volatility and why do forecast it? So we know that volatility is how much returns can go up or down. It's about uncertainty. Clear? So if returns will fluctuate a lot, it will leads to the higher volatility. If they are stable, that means there is a low volatility. Clear? Now, sometimes what happen when we have single assets or when we have multiple assets. Okay, for single asset, calculating the volatility for one stock is quite easy. Okay, we know that we can calculate it basis on the x minus x bar, then whole square, take the sum and then divide it by n, you will get the volatility. But when you have multiple assets, when you have a portfolio, then estimating the volatility will become difficult because then you need to identify the covariance between the two assets, because sometimes the asset move together, sometimes asset move in a opposite direction. So we need to understand that how much asset moves and how they move with each other. So over here we need to consider variance and covariance matrices. So variance covariance matrices means what? Variance means what? The risk of one asset. Clear? What is the meaning of covariance? How two assets are going to move together. So for that, what we do? We create the table. For that, we create the table. Clear? For all the assets like A, B, C. Similarly, A, B and C. Clear? In the table, we show the variance of each asset, say 10, 12 or 18. These are the variances, and then we show the covariance between AB, covariance between AC. Like this, we create the pair between the assets. Clear? And then we calculate the portfolio risk. Clear? Now, we will use the historical data because that is the simplest way to create the VCV matrix. VCV, variance covariance matrices. So use the historical data, calculate the variance, calculate the covariance, and that will be your VCV matrices. Clear? Are you clear till now? Now over here we have few problems with respect to the sample size. If the number of the asset is too large but the historical data is small, the result will become meaningless. Clear? Or like 50 stocks but you have the data is only of 30 months. Clear? So this matrix may show that portfolio has zero risk, which is impossible, but in reality there is a huge amount of risk. Why? Because your data have not captured all possible events in the history. Clear? So there is a standard golden rule to remember, that the number of observation should be greater than or equals to at least 10 multiply with the number of the asset. So if your number of asset is 10, then if you are having the monthly data, then you should have at least data of 500 months. Clear? So you need to have at least 500 observation. Clear? Something like a golden rule. Clear? Now you are not required to calculate all these in the exam. So you just need to discuss the method conceptually. Okay? Nothing more than that. Now, just like we have done a historical based variance covariance matrices, similarly we have factor based variance covariance matrices. Clear? Now, when I talk about the factors, few things which comes to my mind: inflation, oil price, interest rate, the movement of the market. Clear? So instead of modeling every asset separately, we model how asset react to these common factor. See, earlier what I was doing, A, B, C, D, these are my assets, how they are correlated with each other. Now we are not doing this. What we are doing now, how they are connected with the GDP, interest rates, oil price, currency, like this. Clear? Like think of a wind. Okay, wind is a factor, and then you have your boat, that is your asset. If wind is strong, all boats will move more. If wind is weak, that is your factor. If GDP is a factor and how it is connected to all three, it is weak, then all four stocks are going to perform in a different manner. So it's the factor which is driving the force. The factor is the driving force behind the movement of the all four assets. Clear? So what is the advantage, sir? Why we are doing this? The one advantage is fewer observation needed, because if I have 50 assets, then you can imagine that how many correlation I have to prepare. It's way too huge. Clear? So fewer observation needed, correlation come directly from the common factor, and easy to do, faster. Clear? And you are more dependent upon the macro factor rather than between A, B, and C and D, their relationship, because their relationship can change. But my relationship with the GDP, with the oil price, like I'm an oil producing company, so my relationship with the oil pricing is very high. Okay, that cannot change. Clear? Now, why factor models are efficient? Like when I talk about, suppose the number of assets is 50 and we have the six factors. Number of assets is 50 and number of factors, suppose we have is 6. Clear? Then if I would have been using a very traditional matrices, okay, where I am creating the correlation between each of them, then I need 1 2 2 5 covariance between the assets. Clear? But factor model needs only 300 factor sensitivities, that is 50 multiplied with 6. So can you see the comparison? So it's much better. Clear? Now, just like we have the issues with our traditional VCV matrix, similarly, there are some issues with respect to the factor model as well. Okay, there are two issues. One is the fact that they are biased. Clear? I think I mentioned it already. They are biased. And second, they are inconsistent. Biased means what? Inputs are estimates. Clear? Models can be misspecified because you are creating the model, means you have chosen 6 factors. Okay, suppose there would have been 9 factors, you have missed few of them, and few of them might be very important. Clear? They do not predict the true risk even on an average. Clear? So when I'm using the word biased, that means systematically they are wrong. Clear? Because over here inputs are also estimated, the future GDPs, okay, the oil pricing, everything. Next we have is the inconsistent. Even with more data, it does not converge to the true risk. Okay, it does not improve, means generally what we say with respect to the sample mean, higher the data, the better the probability that my sample mean is equals to the population mean. Clear? But over here it is not true. Clear? So sample VCB matrix is unbiased and consistent, but factor VCB is biased and inconsistent. Hopefully you can remember this, that though it is difficult because of the huge numbers, but it was unbiased and it is consistent. To make the thing simpler, we have used the factor VCB, but that was biased and inconsistent as well. Clear? Now, coming to the shrinkage estimate. What is this shrinkage estimate? Over here, we combine both sample VCV, that is based on your historical data. Okay, the first one, and second target matrices, that is target VCV, that is your factor model. I am combining both over here. Shrinkage means what? Pulling extreme estimates toward a more stable target. Write it down. What is shrinkage estimate? Pulling extreme estimates, extreme estimates toward a more stable target, toward a more stable target. It's like I'm taking the weighted average of the two matrices. See, first one is difficult, but it is biased and inconsistent. Consistent, sorry. Second one is, first one is unbiased and inconsistent. Second one is biased and inconsistent. But we know that some of my assets, they are linked to the factors as well. So I cannot ignore that point as well. That point is also very important. Clear? Now, suppose historical covariance is 180 and factor model covariance is 220. Historical covariance 180 and factor model covariance I have is 220. Clear? Now I have to give the weights to both of them. Suppose 60% weight is given to this and 40% weight is given to this. Clear? So what I'll do? I'll calculate them. What is my sum? 196. So this is the shrinkage estimate. Why it is more useful? It reduces the estimation error because I am taking the combination of two. Clear? Second, it is more stable and more realistic. Clear? Even if slightly biased, but results are more precise because now I'm using both the correlation between the assets as well as the assets relationship with the factors. Are you clear? Now, sometimes returns are way too like this. Okay, for the liquid asset, but when I see the illiquid asset, they are more smooth and return. Clear? We understand that if they are smooth, that means the volatility is less, but the reason is they are valued in a very long time period. Like if I have I look at the price of a house, say it was $70, 95, 140, 120, 90, or say 160. But suppose this happened over a period of 5 years, so still you will see a very smooth graph, something like this. Clear? But if it would have been on a daily and a normal basis, it would have been like this, higher volatility, very high volatility. Clear? So we have to smoothen our returns as well as volatility because returns are artificially stable because of the illiquidity in that particular asset, infrequent trading, or appraisal based pricing. But there is some problem, the problem of underestimating the risk. Clear? Or sometimes you overstate the diversification benefits. Clear? Or you flawed your, like, lead to the bad asset allocation decision based on the smoothened return. Clear? So how we fix this issue? Basically, in order to fix this, we will combine the current true return with the past return, and where we are going to use the weight lambda. A asset I have its past return, a asset I have its current returns. So what should be its accurate return on an average? So what I'll do, I'll give the weight, and the weight is my lambda. Are you clear? Suppose my lambda is 0.6. This is the value of my lambda. Clear? Now the let me clear this one. Now we are talking about the variance, not the return. Mark my words. So I have true variance is of 4 and true standard deviation is 2. Clear? So that will be multiplied with observed variance, and true standard deviation, that is 2, it is going to be multiplied with the observed ASTs. Clear? Now risk is much higher than it actually looks. Or in order to make this point looks more simpler to you, suppose I know that my value of R1 and RT minus 1, current and previous. Clear? So what I'll do, I'll give them the weight of lambda and 1 minus lambda, clear? And then I'll get the true returns based on the movement, clear? So suppose it is the value is over here it is 8, over here the value is 12, and suppose this is 0.6, so it will become 0.4. So just multiply them, 4.8 plus 4.8. So how much it is coming? 9.6. So neither it is 8, neither it is 12. The real return is 9.6. The same goes with the volatility. Okay. Current volatility is 8, previous volatility is 12. So what is the true volatility? 9.6. Are you clear? Now the next point over here is your arch model autoregressive conditional heteroscedasticity. Okay, I'm not going to explain you the same thing again. Okay, but again the understanding is important. Okay, now asset returns will show you for both the situation when there is a calmness in the market and when there is a turbulence in the market, clear? So we call this as a volatility clustering. So high volatility will always follow the high volatility over here, you see, and calmness will always follow the calmness, clear? Auto regressive, again the same thing what happened previously. Okay, so today's volatility depends upon the past volatility. This is what it's all about in the time series, that what is going to happen today depends upon the yesterday, what will happen tomorrow will depend upon today's event, clear? So in short, what arch model actually do, they will use the past squared returns, they will use the past squared returns, clear? Y squared, so that we can remove all the negative ones. Now give more weight to the recent shocks, give more weight to recent shocks. We are talking about the volatility, that's why we are talking about the shocks. And capture volatility clustering, capture volatility clustering in the data, clear? Now we know that we have two parameters, alpha and beta. So higher alpha plus beta means, suppose if this value is high, what is the meaning of this? The meaning of this, write down, more emphasis on past volatility, more emphasis on past volatility. Second, write down stronger clustering effect, stronger clustering effect, clear? Now coming to the last point to be discussed, that is the global portfolio adjustments. Okay, see, till now what we have learned is how market behaves, how currencies will move, how volatility will be forecasted. But now the most practical part, that how should an investor will change the portfolio when the world economy is also changing. So this module is not about predicting the exact number, but about making the smart adjustment. Like if economy is changing, my portfolio should also change. Okay, now when I am using the word global portfolio, it means investment across equities, bonds, different countries, different currencies, different credit qualities, different maturities as well, like Indian stocks, US bonds, emerging market equities, or currency exposure like USD or euros, clear? So based on the economic trends, clear, how should we increase or decrease the weights of the different assets, that we need to analyze, and then we need to adjust. Like if I see that market is quite risky, so better I'll move my money from the equity to the bonds. Or I see that Indian interest rates are higher, then why will I invest in US market, clear? Market is going to come into the recession, move your money from the risky bond to the safer bonds. Like this, you have to choose your investments. Clear? So you have studied all, like trend growth. Clear? Why it actually matters. Companies earning the more, their share price should rise. Interest rate usually rise, and hence the bond price will fall. So if Indian economy is growing fast due to the digitalization, manufacturing growth, and young population, then I can increase my equity allocation and reduce the bond allocation, because there I will get the higher returns. Are you clear? So these points we have already discussed, like our market becoming more or less integrated. Clear? Means how I am connected financially with other global markets. Clear? What will happen if it will become integrated? Okay, that Singer Tihar model, portfolio strategy, where is the countries in that particular business cycle. Some are at the lowest point, some are at the expansion, some are at peak, or some are at recession. Clear? So accordingly I will analyze and then I will invest. Barbell strategy. Okay, like invest in short term bonds and long term bonds and avoid the medium term bonds. Why? Because they are flexible and better risk management due to the rising rates. So all these things we have studied, but the point of discussion is that we have to adjust our portfolio based on the monetary policies, based on the fiscal policies, major tax reforms, shifting to the quantitative easing or change in the inflation target from the central bank of that particular country, the current account balance, how much deficit do they have, the currency is weak or strong. So based on that, I am an analyst. Now it's my responsibility to analyze, and then I will make my portfolio accordingly. So all these points I have mentioned over here in the notes in a very easiest possible way. So all you need is just a go through, and then you have a small summary table where you can give a glance of the topic. So with this, we have finished our topic successfully. So I am ending this lecture here. Thank you.